ahead and get this going. Welcome to the virtual bus tour, Passive Investor Network. My name is Ryan McCarthy. I'm going to be your host for the next 2 hours. We're gonna roll out, give a lot of information, talk about what Penn is doing during this time. Not much has changed. Of course, we're social distancing and keeping online, but everybody here at Penn is working really hard for our clients and for the members. So if you're a non-member and you're just joining us and hoping to understand what it is that we're doing and what service Penn has provided, we really appreciate you joining. The reality is that, like every pandemic before, this will end. And what will define us is how we embrace this moment of rapid change and whether we seize the opportunity to accelerate really what it is that we were doing before, down the path that we were going before. And it's moments like this that is the reason that Penn exists. It's during these times you want to have control of your finances, and if you don't have control over it, and a lot of people, we're gonna talk a little bit more about this, but a lot of people hold their cash or buy gold or something like that, and Penn, they feel that if we're able to buy real estate a certain way, we can mitigate our risk through the ups and the downs, because this is, while it is a unique situation, obviously, to us in our generation, and it's very surreal. I'm looking out here at the Galleria, and there's no one out there. It's not something that hasn't happened before in the history. And what I wanted to do today, I brought in our Chief Financial Officer, Jamie Josephson. He was social distancing long before it was cool. And I wanted him to tell us, because he has a lot of experience with this, in the stock market, investing, running businesses. And, the backstory here is we actually began talking about Penn through a friend of a friend. And he was, ready to kind of get off the merry-go-round of the stock market this summer. His advisor was telling him he was seeing some things. So, Jamie, welcome. Thank you for joining us here this Saturday. Not that you were doing anything else, right?
No, I was not. I'm happy to be here. Happy to share a little bit of information. I think that, I want to preface this conversation by saying there's no politics involved in my economics. And so whatever your personal feelings are, I just want to share with you data and information. And so what sparked my interest in what I consider true allocation or portfolio diversification, to me, became very apparent that to be truly diversified didn't mean to own equities and ETFs and bonds. There had to be something outside of that would truly diversify my portfolio, and if I was in a cash crunch, would provide me with revenue outside of having to recognize a loss through the sale of any of those vehicles. And so I did that, and I put my money in the market, and obviously rode the wave and saw that it was going up, and started doing a little bit of research. And I came across a very interesting article one day that stated that over 75% of all activity in the US stock market were companies buying back their own shares.
About this, because obviously it's coming to light, and with this, the government bailout and whatever the politics are of saying, well, these corporations, may not deserve it because of whatever. And, I asked you, I said, what, so over the last few years, it's been uncovered that that's what these companies have been doing. And so I asked you, I was like, why would a company want to buy its own stock? Why would they operate like that? Why wouldn't they put money into their business? So you actually answered that for me.
Yeah, so it's I've been an executive in a corporation before, and one of the things, whether you're privately funded or you're publicly funded through the market, one of the expectations as an executive, and there's a lot of expectations and a lot of pressure to quote unquote drive shareholder value, and we kind of had a perfect storm where corporate tax rates in America were constantly competing with Japan as being the highest in the world. And that's why all the big companies are based out of Ireland and Singapore and not here, right? Because they have enough money to leave and pay those taxes. And so when we had a very significant cut to the corporate earnings, the thought was, and the story that was told was that this is going to be great. There's going to be investment in infrastructure. We're going to have lower unemployment. We're going to have people investing back in research and development. It's going to, all of these things are going to happen. And what we ended up seeing, while we did have, record low unemployment, we saw, and I'll give you a perfect example. So since 2014 through 2020, American Airlines, good example, bought $12.4 billion worth of their own shares. Today, their current market value is $4. They are currently worth $4 billion. They bought $12.4 billion of their shares. I don't know if you have flown American Airlines, but if you have, you know that those are not new planes, those are not new uniforms, and those are not new people working there. You just didn't see what the intention of the tax cuts is not what ended up getting carried out, because when you are an executive in a corporation, the path of least resistance to increase shareholder value is to buy back your own shares. And so
as a corporate officer, obviously you're benefiting from that through your compensation. I mean, these are things that are pushing your value in that company. And it's like you said, it's the easiest way to kind of build this false value. That
it's not what you would term as organic growth. And when you look at something that drives significant value, and airlines do drive significant value, but if you're trading at an 18-to-1 multiple on the same earnings that you had 4 years ago, and your stock is up 37%, then something inherently is off kilter, right? It's not sustainable. And so, it kind of leads in to the next thing. And so the decision that I made at that time is I went ahead and I cashed out. So it wasn't at the tip top of the market, but it was at a position that I was comfortable with. I felt like there was some inevitability there, and I wanted to have enough dry powder to capitalize on that when the time came. And so
what it comes down to. And that's why Penn recognizes the value of real estate as an investment vehicle, because it's about control. It really comes down to control. And if your money's in a company where they're doing things like this, not really driving value organically, like you put it, they're doing things that from the outside in looks, oh man, this is great, but there's not actual value. You don't have control over that. You don't have control over your money in the market. At least short term to midterm. I know long term, everyone says, well, you leave the money in the market. Of course, over time it goes up, it goes down, but at some point, that does not work. Because if at the end of your career, your 401k, you're about to retire, goes down, you don't have the rest of your life to build it back up.
No, that's a very good point that you've made. And I don't want to just be the bearer of bad news, but I want to bring up something else, right? Because as you watch the news today, you hear the word unprecedented over and over and over again, or, we're at war with this disease. And if you take those two things and you do a little bit of research into history, you look at basically what is going to happen next. So when a government takes their currency and they basically produce an unlimited amount of it and make that available to facilitate not just the growth of an economy, but to keep an economy alive. If I gave you one M&M and you like M&Ms, that one M&M would have pretty significant value to you. If I gave you an M&M factory, right, and told you you could eat as many as you want, maybe it's not, they're not as important to you anymore. And so the thing that's going to come next, and you can do your own research, but this actually happened before in the, I know history's boring, but in the Weimar Republic of Germany, they got hit with the bill for World War I. They said, how are we going to pay this? Oh, we have a great idea. We're going to print enough money to pay this bill. What ended up happening was it took an entire wheelbarrow of cash to buy a loaf of bread. And the people that had cash were rich, and the people that had cash were poor, and the people that had real estate and commodities were rich. And so what we have just done now is not unprecedented. There's a history lesson here to look back on and say, when you do this, this is what happens. And so again, to go back to have a truly diversified portfolio, it's not a diversified portfolio if it doesn't include real estate. And I want to say that because, you can't refinance an equity. If you want to realize a capital transaction, you have to sell that equity or you have to buy that equity. That equity is not going to pay you rent. Dividends are minimal, and they always have been, and now they're all suspended. But the other thing that won't happen to your shares is the thing that was driving your value over the past decade, and specifically over the past 3 years, has been share buybacks, not organic growth. And so when you look at a compounded year-over-year rate of return, my suggestion and what the position that I've taken is I've taken a pretty substantial amount of real estate and turned that into rental income for me. And so I feel I can sleep at night. I feel okay. I'm comfortable. Whatever the market does, I don't ride up and down with that. The long term, it will come back. But, I think the point is that why not put yourself in a position that is basically recession proof? These houses that you're going to look at today are in a specific type of strata that you either come up into or you come down into. It's not high-end housing. It's not, boom or bust. People are always going to have a place to live. Penn creates and renovates and rehabs homes to a good standard to provide an attractive tenant. I personally like having passive income. I like getting a check or a deposit in my bank account every month from the properties that I own. It has taken a load off of me and allowed me to make clear-headed decisions, and decisions that are less emotional and less reactional. And it's provided a more stable environment for me overall. And so that's the attraction that I have to Penn. That was my attraction initially in the beginning of Penn. And I've spent my entire career in finance and in business. And I've been
That was
incredibly.
the thing. It was that we were talking about getting you involved, and eventually it was like, how involved do you really want to be? Right now, you're a partner, and you know, helping us actually build this thing out because you know, the reality is what you're saying. It's a necessity of the marketplace. You know, there's I don't think anyone will argue, especially now, that the real estate is pretty good investment. The challenge is where do you get started? How do you do it? Where's your team, et cetera, et cetera. So we're gonna talk a little bit about that. Jamie, I really appreciate you joining in and giving us those things. I think at the end, we'll if we have some time, we'll do some Q&As. And, you know, for those folks who have questions specifically, we'll try to get those in at the end, man. So thank you, Jamie.
Yeah, you're welcome. Thank you,
All
everybody.
right, man. All right, so let's talk a little bit about what is Penn for those folks who, oh, wait, let me get this going here. Are not members who want to know what it is that Penn does and how they do it. We'll talk a little bit about that. So first and foremost, it comes down to the power of the network. Building a network of like-minded investors and individuals that come together that we can leverage our place in the marketplace. Ryan, in and of himself, I don't draw a lot of, although I like to think so sometimes, I don't draw a lot of power in the marketplace. When I go out and I try to acquire real estate, and when I try to get strategic partners like lenders and contractors and title companies and insurance companies, I don't really, you know, I'm just another individual. But as a group, as a network, we can actually go out and we can get we can build acquisition teams. We can build contracting teams. We can get with the best in the industry for insurance, the best in the industry for real estate and investment loans. And so that's what Penn has done, is they built this network out. Also, too, once that network starts investing in these markets, because of the volume that's created through seeing the appraisals of these properties, seeing what the renovations need to be on these properties, the values of these properties, the rental amounts on these properties, there's a pattern that starts to develop that mitigates everybody's risk in that network, because we are, you know, we're making decisions based on information that is pretty clear cut. It's not ambiguous because we've actually seen it. So let's talk about the Penn network itself. The first part of the Penn network is the acquisition team. So Penn actually has a full acquisition team, the deal source. So these are where these guys and gals are going out and buying property in the marketplace. That's you know, could be distressed property, doesn't necessarily have to be distressed property. It's just based on a good model that is proper in the marketplace. And we're going to talk a little bit more about that as I show you the Penn calculator, and as I show you some of the examples of what some of our Penn members have done. But these guys are going out and actually finding these properties, working with the construction team to make sure that the numbers are correct, working with the realty advisors to make sure that the values are correct, working with the property management team to make sure that the rentals numbers are correct, bringing that into inventory, and then that allows a Penn member to take a look at an investment opportunity and then a property and have all of the due diligence presented with no, you know, with no pressure. It's in inventory, it's sitting there, and you can say, yes, this makes sense for me, or no, it doesn't make sense, and you move forward. Now, here's another thing that Penn offers. actual realty advisor that sits with you in a pinpoint session and starts to outline what that looks like in terms of, here's your goal, and here's where we're starting, here's where we want to end up, what type of investments are going to make sense to get to that point. So that advisor then you can hold them accountable, they can hold you accountable to making sure that you do reach that as a Penn member. So when you look at that inventory, you know, well, this is the type of investment I need today. This is the type of investment I'm gonna need tomorrow. Over a 5-year plan, looking at from day 1 to year 5, being financially free, whatever that means for any individual. Sometimes it means retiring their spouse, sometimes it means sending their kids to college, sometimes it means just being work optional. But that realty advisor should be taking you through that process and holding you accountable as you hold them accountable through that. The next thing is the Penn Property Group. Once you've identified an investment that makes sense for you, you actually go and close on that property, and it's your property. You're buying that property through either a hard money loan, and we'll talk more about that, conventional lending, cash, however it makes sense, and you own that property. Now, Penn, because they've already done all of the diligence on the repairs that are necessary, they actually manage that process. So they've already got a scope and a bid. In some cases, they've got an architecture's drawing. They've hopefully started the permitting process at that point, if necessary. And once you close on that property, within a few days, they're starting construction on that property, and they're managing that property until the point where it's ready to be marketed. Once it's ready to be marketed, then the Penn Property Group's listing agents actually list that property for lease based on whatever they're seeing in the current market, right? And it'll line up with what the calculator, what the assumption was when we bought that property. And then once that property is tenant occupied, then they actually manage that property. So it's from pillar to post that Penn actually allows you to invest in real estate. And what's cool is it's as passive or unpassive as you want it to be. You can be as involved or not as you want to be. We have a lot of out of state, out of city folks that have got involved, and obviously they're not here to watch the projects, et cetera, but they're being updated. They're being shown what their returns are. They're being given their owner dashboard, et cetera, to see their investments, and working with their realty advisor to keep going along those lines. So that's basically Penn. The main thing that really actually keeps us driving is our PINcredible partners. And what I'd like to do is see if I can get Sean here, and from Capital Concepts to talk a little bit about what he's seeing in the market. Sean, are you there? Unmute. All right. You're on the phone now.
Now can you hear me?
I can hear you now.
There you go.
There we are. All right, man. We found a way. It was touch and go there for a second, man.
Exactly.
I don't know what happened. We had the same when we were doing a dry run last night. We had the same thing with audio. I think I had my volume down or something. There's just one thing.
I'm sure it's a setting on my computer. I'm not tech savvy, so. But anyway.
Well, that's fine, man. We don't need you to be tech savvy. We need you to get these loans done. So I know, we've been talking, obviously. I know every time I call you, you got another calamity going back and forth. So tell us about this crazy mortgage market, man. Where we at? I guess where we at before the pandemic? Where we at kind of during, and now during social distancing? Kind of outline it for us and tell us what's going on.
Yeah. So a lot. I've been a busy guy to say the least. So before this craziness all happened, there was obviously a dip in rates, which was great. That led to one of the biggest refi runs that we've seen in a 1-week term ever. And that essentially overloaded a lot of lenders. Then right on the tail end of that, this pandemic hit. That, with the volatility, just made total chaos in the lending world.
Yeah, well, back up. So when you say, and just kind of outline a little bit, what when these refis hit, when these rates just went crazy. And I have friends who refied stuff and they nailed it. I mean, they got 15-year fixed for like 2% and 3%. I mean, it's insane. But what happens there, and what we were talking about, was that these, the money that they're lending, they have a finite supply. Some of these, they have to move them around, right? They have to actually move these warehouse lines. They have to sell that paper. And if they can't sell that paper, then they can't loan any more money, right? That's what you're talking about on
right.
Yeah.
Right. So that didn't actually happen right then. But what was happening though, is you were finding lenders that were getting just loaded down with these refis, and they were trying to keep up pace with that. So some of the lenders,
they couldn't do it.
Right. So some of the lenders would actually, even though the rates were down low, would price their rates up a little bit higher to slow down their own volume, just to try to put a slowdown on it, because they just couldn't get these pushed through. And then this pandemic came, and then the volatility in the market got crazy, and then that's where you start seeing such a disparity between the 10-year. Now, granted, 10-year does not dictate what rates do. The bond market and mortgage-backed securities dictate what lenders price at. Now, historically, they do follow the 10-year, but the 10-year dropped. Obviously, the 10-year, it dropped down next to when the Fed cut everything next to zero.
Yeah.
But then the pandemic hit, and so the volatility in the market came, and so rates actually started going up. And because of lenders not knowing, okay, they've seen the stock market tank, they're not knowing then this is what you were talking about, Ryan, is where they were, okay, now who do I have that's going to buy this paper? And so on what I call they're called non-qualified mortgages. So anything that's outside of Fannie Mae or Freddie Mac is considered a non-qualified mortgage.
It's not government-backed security. Yeah. Okay.
Right. So those type of deals for lenders became extremely difficult to sell. No one wanted them. So that's when those lenders, and it was happening daily. I mean, I personally had borrowers at the table ready to close, and the lender called me up and say, "I'm sorry, I'm not funding your loan." And it's because they took the position to, nothing that was wrong with, like in 2008, where they just wrote a bunch of bad paper. They just took the position, hey, look, we as a lender can't keep throwing our money out there, tap out our warehouse lines, and then have absolutely nowhere to sell the paper off. They have to be able to do that to stay liquid to a degree to keep the company running. Well, if you max your warehouse lines out and have nowhere to sell the paper, now you just shut your doors. So
that's
those
where we are
lenders
now on the non-QM stuff. On the
non-QMs.
Yeah.
The Fannie and Freddie stuff is still available. Now, And they're still lending, and I'm still doing those loans. And the commercial loans are still available. It's a little bit different of an animal now, but it is still available. But Fannie and Freddie are still lending.
That's what I want to be clear on, is that, obviously the banks, the commercial markets, those are a little bit freer, right? That's kind of run by a little bit different system than the Fannie Mae and the Freddie Mac, the government-backed securities, because this was kind of happening during that pandemic. And what happened was the government said, "Look, we're going to buy them. We're going to buy these things that are backed, right?" And that's what we're kind of focused on. Are these Fannie Mae things? Are these QM loans, right? Right.
So those are available. We're still doing them. Rates. Of course, all the lenders have they're going to hedge on the safer side. So and where that comes in at is they're increasing rates. So that's just where we're at now. That's the world we live in. So yeah, but they're still not bad. They're still in the fives. I mean, it's not a horrible 30-year fixed rate. So it's
what's interesting is, it's really kind of where it was in the last few years. It's in the 5%.
Exactly. Like go back 2 years ago, and that's about right where the rates that we were at. They dipped down a little bit, and we did get to ride a little bit for past maybe a year, 8 months to a year. Rates in the 4s on Fannie and Freddie type of deals, but because of all of this, they've crept up. That all said, this calms down. Yeah, you're going to see those rates drop again. You're going to see those non-QM guys. They're going to come back into the market now. To what degree? Are they going to put another little twist on their qualifications? Yeah, that may happen. But those guys that weathered the storm and did the right thing for a company, you got to pause those to keep liquid, keep your doors open, and wait it out, and they're going to be back.
And to Jamie's point earlier, it's not like this is unprecedented. Like, there are some things obviously that are unprecedented over the past few weeks that you've seen, but we can basically see, like, as this pandemic ends, which it will, as the economy tries to get back to work, as things try to happen, the government and the Fed is going to do everything they can to loosen up credit, because that's what pushes these markets. And
Correct.
As a result, there are definitely going to be opportunities. And this is why real estate makes sense. They're not going to be lending money to go buy stocks. They're going to be lending money to go buy houses, to go buy real estate, right?
Absolutely.
Yeah.
It's they're going to drop the rates. Those programs are going to come back. It's and I didn't even tell you this, Ryan. So we're always looking for warehouse lines and to increase what we can do. And I sat down with Blake, and I'm going, here, once we get to this the refi stuff, and this is just for our conventional stuff. We got our warehouse lines for our hard money, but this is just for our conventional Fannie and Freddie stuff. I told them, that we're going to get just so waylaid with that it's going to be, we'll tap out our warehouse lines. So I called a couple of our warehouse line, the other warehouse lines, and was in the process of getting signed up with them. And man, they just told me they are absolutely getting slammed with requests from guys like us that want to get ahead of the curve and that are applying for larger warehouse lines, which to me, that's a good sign that, they could see this, the horizon here, that this is going to end. And when it does, it's going to be, game on.
We need to be ready. That's at the end of the day.
Absolutely.
We need to be ready. It's not, a lot of people are, let's just wait and see, and that's fine. That's fine if that's what the risk tolerance is. But the people that take advantage of an opportunity in a marketplace, they're getting ready. You know, they're ready to
Absolutely.
pounce, and these rates are just. I mean, I see it. I think it's going to be just. It's bedlam. It's not 2008 where the banks were afraid of this kind of paper. They're going to have an appetite for this. They're going to want.
Absolutely.
They're going to want these type of loans, man. I mean,
and that's just it. This isn't a financial issue with any of the markets. It's this pandemic that has done this, and it's done it to everything. But once that you keep pulling that rubber band back, and then once that's you release it, it's going to snap back the other way. And I think that's exactly what's going to happen. It's these lenders are going to come back. They're going to open up, just like they were before, and we're still in it. I mean, I can't. They got 8 hard money loans that are closing next week.
We're still moving along, man. Still rolling. So, well, that's awesome, Sean. I mean, I appreciate you spending your Saturday. I know you probably wanted to get out and shake it off, I guess. But I appreciate you coming in and talking to us a little bit. So hang around too. We'll try to do the Q&A at the end here. And so it's Sean Riley with Capital Concepts. It's Sean at the number 4 smartmoney.com, one of our strategic partner lenders here. And, and we're still rocking and rolling, right?
Absolutely.
All right, bud. Thanks, Sean. All right. So let's actually get into the actual bus tour itself. I'm going to show, we're going to go out to Kingwood, where Paul and Diamond and Jack are out there. Diamond and Jack actually joined about a little over a month ago, came in and got involved with their first property. And here's a little bit about it here.
Hey Ryan, I'm here with some of our newest Penn members.
Sorry.
I'm Jack.
And I'm Diamond.
We're here at their new project, their first project. Let's go inside. When you first got this deal, you're looking at the calculator. What did you think about the scope and bid?
To me, it made a lot of sense. I was most surprised with how fast you guys were going to be able to turn this around and get it repaired and get it rent ready.
That scope and bid kind of puts the logic behind the number, right? Why is there a repair number there? How is it made up?
Yeah.
It also defines the work that we're going to do. So I'll explain a little bit about that with you all. First of all, this floor, it's awful. It's got to go. It's been damaged. We're going to wipe this out, put tile in. We're going to obviously remove the tile here at the fireplace. The mantle is scheduled to be demoed. We're going to come back with more of a modern feel, right? A single block of wood. And then we're going to copy the tile from here and into the foyer. So we have a nice even flow and design. Okay. You're going to have new fans, lighting fixtures, new paint, obviously. We just can't keep what was yesterday.
Right.
All right, Jack and Diamond, so now we're in sort of the hallway here, the connector to all these bedrooms. You guys have like 7 of them here.
Yeah.
But what we're gonna do is, again, we're gonna continue repainting all of these things. We have started repatching holes that were in your previous roof, right? You could literally see daylight.
Oh, wow.
It was interesting, but we had to fix it. So we're gonna take a little visit into the master bedroom right now. So we're in the master bedroom. All bedrooms are going to be recarpeted, repainted. We repair closet doors, and then the master bath, right? So what we're going to be doing is, in the master bath, you can see we're currently prepping for paint in here as well, right? But we're keeping things that are still really good, such as the flooring here, the sunlight. It's a big favorite of mine, so you can guarantee if I'm on the job, it's staying. We'll be refinishing the bath, refinishing the tile, resurfacing the cabinetry, but we're keeping the original cabinets. And why is that? Because when we're making bids and when we're making scopes, we're looking at what the market will accept and what will give us the highest value. Nice. And so this is sort of what the acquisitions team gave us feedback for, and here it is in action.
Awesome.
Yeah.
Wow. Nice.
And of course, new toilets, standard with Penn.
I just love how the open concepts that they're planning to do with the house. I think we've lived in very cramped places before, and I just feel like when you walk in here, you can breathe already, and it's not even finished yet. So I just love it. And I also love the backyard. Like, as soon as you walk out, there's already a patio that you're stepping onto. It just seems very inviting, and I really love it. Like, I would want to live here.
Yeah.
This is our first house, and I think it's the perfect first house. So I'm excited to see what else we're gonna do with Penn and the other houses we're gonna get.
So that is Diamond and Jack at their first house, 3030 Creek Manor. Did everyone get the file that was sent? I know Kang is asking about the addresses. There was a file in the beginning of the chat, the VBT packet. That's how everyone's going to be able to follow along. The address of that property is 3030 Creek Manor. So you did get that, Kang. Okay, excellent. Let's take a look at that particular pin calculator. All right. So this is the property that Jack and Diamond purchased. So this is our pin calculator. So right here we have the after repair value of 220, purchase price of 152, repairs of 27. You saw that they're pretty good ways through that repair. These are your taxes, insurance, HOAs, rents, and property management, etc. This is the hard money loan. So for those of you guys don't know, in the packet, there's actually a Pindex, and on that Pindex, it actually defines some of these things in this pin calculator. Now, don't worry, as a PIN member in your pinpoint session, they actually go through these things with you, the numbers and the outputs and all these definitions of these things to be able to identify a good investment. So let's look at the returns over here. This is called a value play. So this is something to where Jack and Diamond are going to invest in this property. They're going to hold it for about a year or two, and they're going to divest it, almost like a what you might call a long-term flip. So they're investing $28,000, and then after year one, or let's say year two, they would profit $75,000 with appreciation, et cetera, in that market. Now, Kingwood, for those of you who may not know, Kingwood's a pretty stable market. And so, but it is, it is appreciating at a certain clip because of the values there that used to be maybe 150, and they're creeping up past 200, like this property here, up to the median, which is 235, 240. So what'll happen is Jack and Diamond will get with their advisor, take a look at this, and go, okay, after year one, what do we feel the value for that property might be? Is it time to divest out of this? Take that money, take that profit, whatever that may be, and then go reinvest that money at that point in time. So the file, you got to go to the top of the chat to get that file for everyone. So that is 3030 Creek Manor up in Kingwood. Let's look at another property that one of our members just bought. This one we took on the actual bus tour a couple of weeks ago, and it was one that was really popular, so I chose to include it on this particular bus tour. This is 3621 Manor. Just bear with me here. I'm going to get this So this is 3621 Manor, the east side of town here, as you can see, which we're doing a lot of, Penn is doing a lot of investment in this area because, just economically, it makes sense inside the loop. It's near the medical center, it's near downtown, it's in the university area. And it definitely, I'm gonna send this file again. Some people are asking about it here. Let me send this file one more time here. So let's take a look at the before pictures for this property. That it's a triplex that was brought to us, and but there was a lot of repairs that were needed for this property. As you can see, this is actually during the process of repairing this property. It needed, I think, 50 some odd piers for the actual foundation. The foundation had this huge crack that ran down the middle of this thing, and it was in pretty bad shape. But they came in, and within a couple days, they were able to fix that crack. I don't know if you can see it right in here. Here. This is the thing about these properties is, everything can be fixed. It's just a matter of the economics of it. It's a matter of the math. Does it make sense to spend the amount of money that it takes to fix this? And that's what we have to base the buy price on. That's what we have to base all of the numbers on, is fixing these things according to a standard, not fixing things because the deal can't afford it, or not fixing it because we want to save that money and we think we're making that money. That's not the case. When Penn goes in, they look at a property and they're fixing everything in a property. Penn wants it to be a certain standard so that, number one, they can get good tenants. Number two, they mitigate the risk of having maintenance concerns and issues long term. And number three, to get the value of that property. If you're not doing the things that it takes to get the value in terms of the repairs, then you're missing the biggest part of real estate, which is leverage. So you want it to be nice. So these are the before pictures. This is 3621 Manor. Pretty rough. Like I said, it had one of the worst foundations that I've ever seen. 50 some odd piers. Also, it had a commercial kitchen in it for some reason in one of the units. I guess they were cooking meals in this thing. Who knows? But let's take a look at the after picture. New roof, brick's been painted, fixed, mended. What I like about this too is there's a lot of parking for a triplex. In the front, 2 units in the back, and as you can tell, I mean, this is very nice, very clean. They were able to rent this obviously very quickly. Actually had it set up for $850, $900 a month, and they rented it for $1,000 each. Main considerations is this street actually goes right into the medical center. I mean, literally, it's one light away from the Texas Medical Center on the south side of town here. And so it's very clean, very affordable housing for someone who might work in that industry. And that's what this thing was rented and based off of. There's our first visited property on the virtual bus tour. The question, is it 2 separate units? No, it's actually 3 separate units. If I can pull this back up, I can. Was everyone able to get that virtual bus tour packet that we sent out? It's important because you can actually see the math and see the numbers. Okay, Kane, good. Thank you, Renee. 270. Here's what's interesting about it. There was a triplex that was a flip that was literally just down the street that they were able to actually use as a comparable market analysis. How much does the surrounding houses impact the rentability of a property? Well, that's a good question because it absolutely makes a difference, right? But there's data to support what that market is doing. So we can actually look at the last 6 months, the last year of the market and see what something like this rents for. With this particular square footage, a 2-bedroom, 1 bath, the finishes, the condition of a property, it's very clear what these things rent for based on the rest of the market. So if we're looking in that sub-market, then we can actually see, oh, look, Kane put a copy. I'm going to send out this. Thank you, Kane. He actually sent a virtual bus tour shareable link that I'm going to send out to everyone. But Fidelis, it makes a big difference. But what they're doing is they're actually looking in the market to see what these things are renting for. Yes. And also, too, as I mentioned before, because Penn has a lot of inventory, Penn has a lot of clients that have rentals in this market, there becomes a pattern that's shown that's kind of insider information somewhat, if that makes sense. I just sent out a link for everybody to actually see. Kang, one of our members, actually put a link together for the virtual bus tour that I just sent out through the chat. And you can click that. You should be able to see that. But let's look at the numbers here real quick. So the after repair value was 270. As I mentioned before, it was something to where there was another property that was comparable down the road. The purchase price ended up being 121. The repairs were 108. So over $100,000 repair. I mean, $30,000 plus per unit. I mean, that's a massive rehab budget. It took quite a while from start to finish. And you saw the difference, right? You saw the difference in that property from when they started on that rehab to when they finished. With the taxes and insurance, there's no HOA, obviously. The monthly rent, like I said, ended up renting for $1,000 a door. It was about $59,000. But the monthly profit is $1,300. So that $58,949 actually cash flows over $15,000 a year in free cash flow profit there, which is 26% cash on cash return. That's after mortgage, after insurance, after taxes, and also after the Penn management fee of $100 a door. So that client, and I was talking to, this is actually Kaleem, I was talking to him a couple days ago. He called me just to see what was going on, and he said, man, I've taken a pretty big hit in my 401k. But this is, they joined in about a year ago, and they have 5 properties, including this one. 2 of them are actually under repairs right now, but 3, including this one, at cash flow. And he said, "Man, I'm really happy to have this cash flow coming in, during this time." So it was definitely a good investment for him. Let's see. With property taxes being such a large expense item, how do you guys estimate the new assessed value after acquisition and repair? Are you contesting the appraised values? Yeah, we're always, every year, and we actually have someone who does this, who's a strategic partner for us, and it's coming up in May. What'll happen is, obviously, the first year, you don't really have to. All you have to do is provide your contract, and that price, whatever that contract price is, that's what they use to assess the value. Now, you still have to protest it. You still have to go through that process, but it's pretty easy. It's actually informal at that point, right? After 1 year goes by, they go back out and they see, oh, well, especially because we're pulling permits, et cetera, they see that the property's gone up in value. Then you have to take it and make sure that you're contesting those values. And we have someone who actually does that. I used to do it for my own personal portfolio quite a bit. I enjoy it because I enjoy doing that. Yeah, you're talking about the value, Kang, in terms of protesting the value. Yeah. That's it's a pretty easy process. I mean, especially in the counties here, with the, it's called the appraisal district. So you have Harris County Appraisal District. In May, what will happen is they'll send out the value. They'll say, okay, here's what we think the value is from their standpoint. And then they also send out their comparable market analysis. So they don't hide the fact that, okay, this is the value, and then this is what we think, this is what we're comparing your property to in that marketplace. And so what we have to do at that point is say, well, these properties are comparable or they're not comparable, and this is why. And so it's kind of, back and forth of creating a case to address that, and to get that value as low as possible. It's funny because we want our appraisers and our banks to see that thing as best we can, because we want it to appraise high so the loan is more and we're less out of pocket. But when we go to the appraisal district, we want to tell them, oh man, this house is not really worth anything. So you kind of play this balance in this game, and everybody, no matter whether you're an investor or you own your home that you live in, you should always be protesting those taxes every year, because it's their job to make sure that, hey, we're maxing out this value so that they get here in Texas. That's how we're not able to. That's why we don't pay income tax, because they do these property taxes. So we want to make sure that we're keeping them honest over there at the appraisal district. So, okay. So that's the deal. I mean, that's something that over time, I think is just a phenomenal investment. And I don't think Kaleem and them are on the Zoom today, but they've made some really positive decisions here. So let's go back and let's take a look at another property. Is everyone getting the link and able to get that file, hopefully, so we can kind of go on this, go down the rest of the bus tour here? We're going to drive a few more minutes down to Good Street. that actually the Simons are going to be closing on next week. Popular one that we went on the bus tour. This was a property that was available on the last bus tour, and I love this house. I really do. Penn's been working really hard to get this thing. There was a lot of title issues and things, and finally got it clear. It's a 1.5-story house inside the loop over inside 610 there, in what they call Medical Center South there, South Union. But I just think it's a really great little house. Oh, here's a house behind it that's very similar. I don't know if you guys can see this, but this house is behind it. It's very similar. It's part of the what they built over there. A lot of houses in this area are really small, 2-bedroom, 3-bedroom with 1 bath. But this particular property, and there's some like this one that are 1.5 stories. It was just, I guess, how they built them back in the day. So this is a good indication of what this one's going to look like once it's done. But as you can see, we got a long way to go before we get there. This one's pretty rough, and I tend to like them rough because it looks. This property's already been purchased, Kang, on the last bus tour. So, and they're closing on it, like I said, here next week. If you take a look at this, obviously, all this thing is going to be gutted. All this trash is going to be gone. The downstairs is going to have 2 bedrooms and a bathroom, the kitchen and the garage and the living area, which I don't know if you can tell, but this is the kitchen. Oh, those are some cool license plates. I didn't notice that. That's really cool. Stephanie, she likes picking these things and going and seeing all the antiques that are in these houses. Let's take a look at the numbers, if I can get that up here. This one was the appraisal type of home it is, finding a comparable property. Right here. Yes, okay. So it took a little while for the appraisal to come back. And when we first looked at it, we thought it was a 280 ARV, which there are homes that have sold that are comparable for 280. But the repairs are going to take a long time, and it's going to price some of those properties out of the market for the refinance. And so we wanted to make sure that we were putting, Penn was putting that client in the proper position, where 6 months from now, when they're looking to refinance this, what comparables are they truly going to be looking at over that period of time? Because we have to look out and see what's going to be happening, in this market at that point in time. And so we worked really hard with one of our strategic partners that is a appraiser, Sam, and he has another guy that works with them that really has a gift of kind of identifying these markets. So we had an ARV of 248, And so the purchase price is $72,500 with a $120,000 make ready repair budget. It's going to be massive. So this thing right now is a 3-1, and it's 1,400 square feet. It's going to be a 4-2 with a 1-car garage at 2,000 square feet. Very, very marketable. Very nice house. And once again, just kind of where it is in the market, inside the loop over there, it really is going to it's going to be something that's going to be nice to hold on to over time. Now, this particular property is a hybrid. I mean, usually you have either high cash flow or you have a property that has high equity. This particular property is actually both. So you can really do whatever you want. You have a lot of options with it over time. So even if we look over a 2-year span of keeping it, there's 3 capital gain, meaning that the $30,000 invested is already realized in captured equity. So this is really important to state that in a market like this, that is, can be tumultuous, you look at it and you go, is my value, am I going to lose money, right? Well, day one on this property, they're going to make $31,000, gross in unrealized capital gain, meaning that they doubled their investment here. So in order for this type of investment to lose money, it's going to not only have to lose this $31,000 in equity, but also go down another $30,000 in value. It's just unlikely, right? I'm not saying it's not, it couldn't happen, but it's very unlikely. And then over time, you also get the cash flow. So this thing cash flows after management at about $448 a month. In this market, there are several comparables that are renting for $1,700 plus. And so the cash flow on this thing is going to be 18% return cash on cash, meaning that every year this property is going to throw back about $5,000, which is tax-free, depreciated against the asset, excuse me, and money coming in every year while their equity goes up and while their investment actually stays the same. So after 2 years, the total cash flow is a little over $11,000. Not to mention that we're paying down principal too. So every month that they get that rent, they come in and they pay their mortgage payment, which means that they're paying that principal down, right? The appreciation in this area, we're using 7% in this model, but in this zip code, 77021 in Houston, if you look, it's double digits. So we're using an average of Houston, which is about 7%, but over 2 years, this investment could give them a profit of about $90,000 if they chose to divest that. Now, of course, that's gross. If they go sell it, they're going to have to pay fees, et cetera, et cetera. But that's a pretty good return. Also, too, you look at it, you're like, where am I going to park my money? Where am I going to park my savings through these times? And then over and above that, where can I put my money where it'll make money? Where can I put my money where I can actually get the returns every month? It's right here, So excited about this one. It's going to be a long rehab process, but man, it's going to be just a really, really beautiful property. And the Simons actually are taking that one on. But look, folks, there's more. take a minute here. Everybody still with me? Dropped off, huh? Everything is still rolling. You know, the crews are going out as best they can. There has been a little bit of drop off along those lines, but you know the city's still working with us. Everything's still happening along, you know, in those. All right, everyone's still here. Let's move on to the next property here. Faster than actual real bus tour. This is a property that is available, and I love in this market. It's similar, you know, in 77021, but it is on the east side of it, closer to kind of the university side. Excuse me. Which I find, well, I'll tell you this. What's interesting is that over time, it has actually been the east side of 77021 inside the loop on this side in Houston was actually getting faster because this is where the new metro rail comes in. I mean, the metro rail takes everyone from, you know, to University of Houston, University TSU. It goes to the medical center and then all the way up through downtown in the north. So this southeast corridor started kind of getting hot before the rest of it did. And now, you know, as you can see, everything else is starting to actually come on the market as well. So let me see if I can share my screen again here. So let's take a look here. Everyone there for a second. So let's resume here. Here's Pomander. Like I said, if you look in this eastern kind of corner of inside the loop, this is where the university area is. The rail goes right along here to MLK up to the university area and into downtown, and then all points north. So this property that is available, and we'll go through the numbers here. Now, I really love where, like I said, this particular neighborhood, we have quite a few rentals Penn has done in this area. And this is somewhere, again, we're going to add square footage to this property. So at the end of it, it'll be a 4-bedroom, 2-bath, at about 1,600 square feet. Just another. And all the front of the house will actually be redesigned. If you look at in the front, right here, property, or Penn is working on a property that's just down the street on the same street. So it's going to be a very similar type. So let's think. You can actually do, the question was, can you show using conventional financing? Yeah, you can actually, you know, the calculator does that, and I'll show you when I share my screen here. Right, there's an option where 2 or 3, and 2 straight conventional financing. The reality is though, most of the properties that Penn does, you can't actually buy conventionally. You have to use that hard money loan up front in order to make that work. So most of the calculators we look at are number 1, which is that hard money. So the after repair value for Pomander is 229. And once again, talking about the network itself, we know this because there's a house down the street and we already have the appraisal for it. It's the same house. Purchase price being 110 and repairs being 70. This is a value play. So you're going to invest 28, capture $28,000 worth of equity, meaning that that's over $50,000 in equity, including what you've invested. The rent for this property is $1,550 a month. So after all of the mortgage, insurance, taxes, etc., you're going to profit $223 a month, which is a little less than $3,000 a year, which is not on your money. But the play on this is to divest out of it in a year or 2. So we have the return at year 1, flow, your principal pay down, et cetera, getting your total profit to a little over $50,000 on a $28,000 investment, meaning you get that $50,000 plus you get your $28,000 back, where you can actually go out again with your realty advisor and take that money and put it back in the market and let it keep working. One question here. Question is, what about funds from self-directed IRA versus hard money loan? You can absolutely do that. Now, I don't know if you're talking about your own self-directed IRA or you're talking about using maybe someone else's. Because there are people that lend money out of their, oh, this is your own. So, okay. So there's actually, and we've done this a couple times, and I think Dale's on the call. He actually did this with a property in Spring. We have a partner that's a lender that will lend to the IRA. So you can actually and because it's all done within the Penn ecosphere, you're never touching the money. So the money goes right back into your self-directed IRA. So there's no chance that it's going to get disqualified. So what happens is the loan is not to the individual, it's to the IRA. It's to that entity that's set up. And the house pays everything out. The loan is a non-recourse loan to that entity, and the rental income goes right back into the IRA, where you're making, a 10 to 20% cash on cash, plus all the appreciation, plus everything like that. So it's really great. Also, too, we have hard money lenders that actually will lend on a property, because there's a couple of different ways to do it, but I really think I like it. It's cool. We've done it probably 3 or 4 times at Penn with people with self-directed IRAs that are able to buy real estate in their portfolio, so that their IRAs are growing at a really rapid rate. And I'm sure that Dale's pretty happy that his money is in a house in Spring and not out in the stock market right now. But yeah, thank you, Renee. Thank you for that question. So, Pomander, that's a property that is available for the members that are on the call. If you're interested in Pomander, or if you're interested in any other property, I'm going to put Steve's information, SMK, passive investor. You can actually give him a call, and this is for members. And he has properties that are available. You can give an email. That's for members.
He's always wanted to invest in property, and I've always been scared. And then slowly, he's very conniving. He started introducing in the last 6 months, we should do property, we should rent property. I met this guy, cool, his name's Ryan, and then boom, we're here, we're a member, and we have 3 properties, actually 5, if one's a triplex.
5 doors, yeah. 2 are rented, and one, the triplex should be done with reno here in a couple weeks.
Yeah, that's pretty quick.
So our first bus tour is like, so I'm the one who's like, hey, I want to kind of jump in. I probably am a little bit more risk tolerant than my wife is. The first house we saw, it was awful. I mean, it was it smells like money, right? And I'm standing in the master bedroom, looking up at the ceiling, and I see sky. So
Multiple sky
there's
groups.
a hole in the master bath, hole in the master bedroom.
Hole in the kitchen.
And then Stephanie said,
I love this place. I had to have it.
but I think it was the mix of, hey, based on the budget, and I think that's something we've kind of come to realize and something we lean a lot on is the numbers, right? Based on the numbers, if we could fix this property, I think what Stephanie's on it had great bones, right?
It was a cute house.
That was the first house we bought in at least a month or so ago. You know, it's an older house, was in disrepair, found a few things. So I think it was a month over. But at the end of the day, we walked it beautiful. I mean, I think it exceeded our expectations on the finishes. Ray was our contractor, did a great job. I've been looking on MLS for a while and trying to find those deals, right? So for me, it was, hey, there's an initiation fee. But for me, it's the cost of education, right? You're bringing a network of people in, people who have years of experience, who've been doing this for a while. So I think that fee is it's the stupid tax, right? Either I could go out there and pay much more in the learning curve versus, hey, let me get these guys experience, get ramped up. I never could have bought 3 houses in 3 months. No. Never would have happened. So I think it really kickstarted kind of our investment path pretty quickly. I think my goal for the future is, hey, I'm looking for about 80% of my net income by the time I'm 60. So I think that ends up being 20 houses or so.
20 is our goal.
Yeah, you know, it depends on a lot of different factors, but
it kind of scares me.
Yeah, so we bought 3 in 3 months. Yeah. We should have 7, 8 within 1 year. Yeah. So I think 20 in 10 years is more than doable. You know, what's that learning curve? What's the market going to do? Obviously, a lot of different things kind of come into play.
By him understanding the model and then explaining it to me with our, when we first started, then I was able to see that they've really covered everything. I haven't found anything not in the model that should be.
But we actually are refining our house and taking some money out this year. So I'm going from a 20-year to a 30-year. I'm lowering my monthly cash flow in my primary mortgage, and we're taking some money out to go buy some more houses.
That was actually Kaleem and Stephanie who owned Maynard over there that we were taking a look at. So you guys have been awesome. And I appreciate you joining us. And I assume that we're going to be doing quite a few of these now that we've got it all set up. We'll be sending out some more information on the everything Penn going virtual. Essentially, we've been a company that has kind of prided ourselves on the hands-on aspect of real estate investing. But obviously, until we all get through this, we're gonna go online, and we're gonna provide the same level of service and provide the same level of information out there to you guys to make sure that we're getting people involved. The Penn is getting people involved in real estate investment. So that we can protect our savings, protect our assets, and be able to weather the storm, no matter what it brings. So what I want to do is talk about the membership. So by now, you know that Penn provides the deal source, and our acquisition team is as I'm speaking out there finding stuff for our members. By now, you know that we are that the realty advisors help you through that process. You understand that the repairs and the property management and the leasing, everything is done for you. And also by now you understand that Penn has these partners, these strategic partners that allow us to do the things that they do. Let's talk about the big three. This is where the rubber hits the road. And this is what they discuss in a pinpoint strategy session. The big three, understanding the current market. Now, this is very important when you're looking at where can I go? How do I do this? And this is probably what prevents a lot of people from actually getting involved in real estate. It's because they don't understand the current market. At Penn, because they have so much volume and because of the network, they're able to see trends in the market that normal people like us, we just can't see. And so having that understanding of the market then gives the comfort to be able to say, we can actually look at this and schedule a goal based on this. So speaking of a goal, that's the second thing that's probably the most important, is calibrating a real goal, meaning I need to retire, in 5 years, I'd like to be work optional. Here's the dollar amount that represents, and here's where I want to get. And based on that goal and based on whatever that number is, once we have an understanding of the current market, we get back into the math of it. You get back into, this is how much cash flow you need, or this is how much equity you need, and this is how many properties that we need to actually invest in, right? And then once you have that, that's the executable plan. So the third thing is obviously taking that plan with your realty advisor and actually taking action upon that. Now, once you have a plan, and this has been my experience, and it's been the experience of a lot of members that I've seen, once they understand the current market, once they understand the goal and have a plan based on that, it's very easy then to take action along those lines. And that's what happens. So then your realty advisor, that's when they start presenting those deals to you. So here are the membership options. The Pintroductory membership. This particular membership is just the Pintro session, right? You get access to the Penn Partners list. You get analysis of your current state, the current market, obviously, and how you fit within that goal setting process. The one-on-one consulting, that's something that you get throughout that 1 year of membership, right? And then a pinpoint investors plan. That's a plan that's put together for you that you can go out and take advantage of. And then all of the bus tours, obviously when things get back up to normal, we're having normal bus tours, 1 year of event tour attendance. Now, the typical membership fee for the Pintroductory membership is typically $15. Right now, they're doing it for $1,000. So you get all this for 1 year for $1,000. Pretty good. Let's talk about the all-inclusive membership. Now, this is really where Penn helps people invest in real estate. So you get everything from that pinpoint strategy session, right? Access to the Penn network, okay? The bus tours, obviously, but during those bus tours, they have an exclusive deal review for members only that you're allowed to go and be involved in. The deal sourcing, this is where you get the deal sources, all of the underwriting of those deals, vetted deal sources, and then they actually take care of the closing process, the inspection process, renovation process, the property management, etc. Then you get full access to any masterminds, members-only events, and social groups. So typically this is $6,500 Today, they're doing it for $5,000, which includes everything: your consultation, your realty advisor, from pillar to post, everything that you need to invest in real estate here in the Houston market. So if you're interested in becoming a PIN member, all you have to do is send the email to membership@passiveinvestor.net. And one of our salespeople will actually get you the paperwork, get you signed up, and we'll be doing these pinpoint sessions virtually until we get through the pandemic. So, what I'd like to do is do a little Q&A. We can open it up. Does anybody have any questions? No questions? Jamie, you still there?
Yes, I am.
Okay, thank you, Renee. Oh, one of the questions, I opened Jamie's, so if anyone has questions for Jamie. One of the questions is, how long have we been in business? Almost, I think May it'll be 2 years total. May will be about 2 years. Thank you, Renee. I'm glad it was comprehensive. We try to pack a lot in there. Anybody have any questions for Jamie? Anybody have any questions for Sean? How many properties so someone's asking, how many properties have you acquired? Are you asking for me personally or for Penn total? So I can go back. So my background is I started investing in real estate in 2011, and I got up to 28 properties, 28 doors, including apartments and some small apartments, some Airbnb stuff, things like that. And then in 2015, I started helping people acquire properties, basically doing what I was doing along those lines. And since 2015, I've assisted on over 500 transactions. And half of those I've done with Sean Riley. over the years, we've been working that whole time. So how many properties have you acquired from Penn? Meaning that how many properties has Penn helped on? It would be several hundred at this point. I think that's what that question means. So quite a few. I think right now we have close to 30 projects going on just over the last couple months. And they're pretty extensive, large projects. With what we're doing, obviously you've seen some of those properties and the type of rehabs we're doing, or that Penn is doing out there, are really really extensive. But I think it's good because you end up with a brand new house. Anybody have any questions? So Alex and Jacqueline are the membership individuals, and so I'm sure you guys have been talking with her. For those folks who aren't members, and like I said, if you want some more information on a membership, you can feel free to email. You can email membership@passiveinvestor. Oh, this is a good question. What is the DSCR to qualify for a loan? So it actually, that number changes based on the type of loan. Debt service coverage ratio is it's in the calculator as well, Dow. And typically it's 1.25 to 1. I think 1.17 was kind of where it was. Now, just so you know, like with what Sean was saying, using commercial lending, things are going to change. So you're asking, can K1s be used for additional income to qualify for a loan? Yeah, absolutely. As long as it's in your tax returns. And I can unmute Sean. Sean, are you there?
Yeah. Yeah, you can use the K1 for the income, absolutely.
Yeah.
And then the DSCR info as far as commercial loans go, they still look at that.
Yeah.
But they're also looking, unlike where a month ago you could get a loan where they wouldn't even look at your tax returns. It's just the debt service coverage ratio of the property. Your credit's good and a little money in the bank, you got a loan. Those have been put on pause. The commercial loans that are available they're going to look at the DSCR. That's absolutely important to them, but they're also looking at the strength of the borrower. So they are going to be looking at the tax returns. They're going to be looking at, everything. Not near as strict as Fannie Mae would by any stretch,
right?
But they are going to be looking at the strength of the borrower themselves.
Sure. That's going to be important. I mean, moving forward,
Yep.
right? I mean, they were loosening up, but
Yeah,
they're probably going to constrict a little bit. But I know for a fact, like and I'll say this about you, specifically, when you get into that realm, Sean is about as good as it gets, man, because he's staying, with his finger on the pulse of those things. And every bank that is, lending on a non-QM basis, they have different things. They have different appetites. And if you're not staying ahead of that, if you're not understanding, if you're not having those conversations, then you don't really know where to act. And man, Sean is staying right with them. So those you can look for those things that's not any different, right? Those things change all the time in good times, right?
Oh yeah, absolutely. Yeah, I mean, Blake has a few properties. I've got some. So I mean, we're investors ourselves. We're constantly scouring out there for new programs. That's got better terms, better rates, better everything. So it's a constant search for all of that.
The name of the game is cost of money, right? I mean, overall, it's
Absolutely.
leveraging and cost of money. And as an investor myself, I was always looking for those things. I was always looking for those programs, but it's a lot easier to just let you do it and call you.
Yeah, there you go.
All right. So we have a question from Brad saying, I think we're going to see some great opportunities over the next few months. I agree with you, Brad. Some property owners have to sell. Yeah, I mean, obviously in Houston, we have a couple different things that are happening. Unfortunately, not only is it a situation where the stock market nationally has gone down, but the oil, is gone to an all-time low, and we're looking at that. And so, yeah, a lot of properties. There's going to be a lot of distressed folks, unfortunately. And he asks, how well are you positioned to find those deals for the members? I can tell you right now that when this, before this happened, we were well positioned for it. But I'm a believer, and I'm pushing the team to really double down on those efforts, because right now everyone's kind of in this hold and wait and see. I just don't believe in that. I think we need to be taking action. We need to be moving. And so that's the direction that I've given our team, is we need to be out there double downing. So we have our VP of acquisitions is actually out on the field, out on the road. He's not obviously he's not in the office. Nobody is, but we're out there taking a look and seeing these properties and seeing where we can actually take advantage of some of these opportunities. Really, the opportunity is not so much the fact that there's property owners that have properties to sell, but it's more to the point, if you're the only one doing it, excuse me, then you have no competition. Or if you're one of the few people doing it, you have no competition. And so that's what I'm more interested in, is while everyone's sitting around waiting to see what's going to happen, let's get out there and let's make something happen. Let's do it. Let's not just wait, because we got to get ahead of the curve on all of these things, ahead of the curve on the properties being acquired by Penn, ahead of the curves on the loan types and things that are available through this process, on and on and on and on, So, Brad, I appreciate you asking that, because that's going to be important moving forward, is who's out there and who's making those moves. That's why it's nice to have the network, because as an individual, if I just, try to go out and try to find a few properties, man, I'm going to get trampled by these larger, hedge funds, et cetera. But at Penn, we have this thing that's built, this machine that's built, that we're a part of, and that we buy into, that goes out and can get us in the market like a hedge fund, like a larger entity. G. Clark says, how long does it take for you to complete a project? And does your team handle mold remediation? Yeah, mold remediation is not really that big a deal, and that's something that's easily handled. How long does it take to complete a project? Right now, we used to do $7,500 a week. It was kind of the math that we used. We've reduced that to $5,000, not because our crews are slower or anything, but because of the permitting process on some of these projects. Now, you saw with Diamond and Jack and their house in Kingwood, there's no permits required. So that's going to go, and that's going to be a normal thing. That's going to be a normal rehab, where it's be about $7,500 a week. But when we're talking about some of these houses that you saw that are almost complete rebuilds, they're taking a lot longer. And we've kind of learned, through a few of those, that we are budgeting for more time as we move along. So about $5,000 a week is what we're budgeting for those. Now, those are on projects that have pretty extensive permitting, right? Just rebuilds. But something that's probably anything north of $50,000 is going to need quite a few permits as rebuild. Obviously, you looked at a project that was $108,000 on Manor. Luca's $120,000. I mean, those properties are going to need pretty extensive permitting. One of the things they've also learned on the contracting side is to get that stuff done ahead of time, and to make sure that we're getting the drawings in, we're getting the engineering reports, so that we're not burning up the time that the client actually owns the property to get that done. And right now we're limited to the Houston area, which, I mean, it's a massive area, obviously, from Conroe all the way down to Galveston, from Sealy to Beaumont. We're in that market. So for a new member getting started, what is needed and budget? Here's the thing. It doesn't matter where you are. And I had this experience personally. Someone who started in real estate. I didn't have a lot of money. I didn't have, all of the I didn't have Penn for sure. But what I can tell you is you start where you are. It doesn't matter, if you think, well, I don't have a bunch of money in the bank, or I don't have, $100,000 to go do this. You got to start somewhere. You got to start putting a plan in place to get going. So, you look at Diamond and Jack, they're young. And they don't have a tremendous amount of money. They haven't had their whole lives to save this money, but they're starting where they are. and they're taking a property that is a pretty safe bet, and they're able to, through Penn, through the process of understanding the market, through the process of getting a goal, and then through the process of having an executable plan, they're able to start. So, Anthony, your question, what is the new member getting started? What is needed? What's needed is just getting started. And the budget, that depends on what your goal is. It's all backs into a goal and understanding the current market and then executing upon that. And I believe, because of my own experience with my own personal real estate investing and what I've seen other people do, hundreds of people that I've helped over the years and that Penn's helped over the years, anybody can get involved and start at any time. And that's really the vision of Penn, is that anybody, no matter what, can get involved and invest in real estate. So I really appreciate it. We went a little bit over 6 minutes, but hopefully we packed enough information in. Like I said, if you guys are interested in memberships, you can do member at passiveinvestor.net. Thank you so much for spending your Saturday afternoon with us. And, we hope to be talking to you soon. Thank you guys. God bless. Have a great day.